This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 13, 2026, and this is the London session. Now, let's get into it. The market is screaming fear, but the charts are whispering silence. The Fear and Greed Index has plunged to 14 out of 100, marking an extreme level of anxiety among investors. Yet, the VIX remains suppressed at 15.28, creating a dangerous divergence where complacency in options pricing clashes with panic in sentiment. As we look at the Forex markets, the US dollar is rallying on mixed signals. Producer price index data missed expectations, yet the greenback strengthens as traders dig in for a higher for longer Fed stance. We are starting the Thursday, August 13, 2026, pre-market session with this tension at the center. Let's look at the schedule for today. The primary data point arriving this morning is the U.S. initial jobless claims for the current week, coming in at 209K against an estimate of 202K. That unexpected rise in claims signals softening labor conditions, yet we've seen the dollar refuse to budge. Later in the week, on Friday, August 14, we'll get the U.S. retail sales figures, which will be the next critical test to see if consumer spending is truly slowing. And finally, the GDP Now estimate will also be released Friday, offering a snapshot of Q2 growth momentum. Apex, with claims rising and PPI cooling, how does this shape your opening view?
It shapes a distorted view. We are seeing a clear decoupling between macro fundamentals and price action. The data suggests a cooling economy, claims up, PPI down to 4.7%, yet the market is pricing in a higher for longer rate environment anchored by the 3.63% Fed funds rate. My synthesis right now is that institutional flow is ignoring the softening labor data in favor of the Fed's hawkish rhetoric. We are seeing capital rotate into safe havens like gold at 4,396.1 and dollar-yen at 159.447, not because the economy is hot, but because the market is afraid the Fed won't cut rates fast enough to save it.
Let's dive into the headlines driving this move. First, Fed official Hammack stated he needs some restraint from monetary policy to bring down inflation. Simultaneously, Fed's Barkin noted it's still an open question on whether the EFF-OMC needs to hike rates. On the European side, polls indicate the ECB is poised to deliver another rate hike in September. Pulse: how do these competing narratives from Washington and Frankfurt impact the broader sentiment? The impact is a structural reinforcement of the US dollar. Even though PPI missed at 4.7% versus the 4.9% expectation, the market isn't celebrating that disinflation signal. Instead, it's listening to Hammack and Barkin. The narrative is that inflation is sticky. Core PCE is still at 3.29%, so the Fed will maintain restrictive policy. This pushes investors away from risk assets and into the dollar and gold. The ECB's potential hike adds fuel to the fire, as it widens the divergence between a hawkish ECB and a hawkish Fed. But the sheer volume of safe haven demand is currently overwhelming cross-border policy debates. The sentiment is purely defensive. And looking at the broader equity context, Cisco is mentioned as a potential cooler for the AI-led market rally. How does that equity weakness translate to the Forex desk? It translates to a risk-off posture. When leading tech names like Cisco face headwinds, the AI lead loses steam and capital rotates out of high-beta assets. In Forex, that means we see weakness in commodity-linked currencies like Aussie and Kiwi. The AI lead cooling down removes the optimism that usually supports riskier FX pairs, leaving the dollar to dominate as the default destination for capital preservation. Let's turn our attention to the technicals. Grid: the euro-dollar is sitting at 1.1522, having tested the 5-day low of 1.15197. What does the chart structure tell us about the path of least resistance here?
The structure is explicitly broken. We saw a sequence of lower highs from the 5-day high of 1.15678 down to the current 1.15217, which confirms active selling pressure. The price has effectively breached the previous day's low of 1.15197. This isn't just a dip, it's a structural breakdown. The path of least resistance is downward. Unless we see a decisive close back above 1.15678, which seems unlikely given the volume profile, the 1.15197 level has become a ceiling rather than a floor. The chart is telling us that sellers are in control.
CIPHER, do the flows align with that bearish technical read? Who is initiating positions in euro-dollar right now?
The flows confirm the technical breakdown, but with a twist in the counterparty. While retail and leveraged funds are piling into pound longs, euro positioning is less crowded. However, look at the broader DXY picture. Leveraged funds are net long DXY by plus 4,438 contracts, though that number dropped by 7,100 week over week. This suggests that after the initial hammer down, some profit-taking occurred. But for euro specifically, asset managers are net positive in euro, plus 219,262, which is interesting. They are buying the dip while speculators are shorting the trend. That divergence often leads to whipsaws. The technicals say sell, but the smart money is quietly accumulating euro hedges, expecting a potential mean reversion if the VIX spikes.
That brings up a crucial point about volatility. SPECTER, you flagged earlier that the VIX at 15.28 is dangerously low compared to the fear and greed score of 14. Does that suppression create risk for the euro-dollar breakdown we're seeing?
Absolutely. It creates a volatility bomb. The VIX is compressed in a 14.77 to 18.43 range, while the fear index is at a historic extreme of 14. This decoupling means the market is underpricing tail risk. When the VIX eventually breaches that 14.77 lower bound, the repricing will be violent and nonlinear. For euro-dollar, this means that support levels like 1.15197 are not static lines. They are suggestions waiting to be erased by a sudden surge in volatility. If the VIX expands, the safe haven bid in the dollar will accelerate, pushing euro harder toward 1.14 or lower, regardless of what the asset managers are buying. The technical breakdown grid described could turn into a gap down if that volatility constraint snaps.
Let's move to cable. It's struggling at 1.349, hovering just above its 5-day low of 1.34832, well below the 5-day high of 1.35462. Grid, what's happening on the pound chart?
We are seeing severe technical exhaustion. Cable has failed to reclaim the 1.35462 resistance zone repeatedly, and now it's trading right at the bottom of its 5-day range. The lack of buyer conviction is evident in the tight range between 1.34832 and today's intraday high of 1.35006. There is no momentum upward. The chart pattern is a classic distribution phase, selling into rallies. And now that the bids have run out, the only direction left is down. A break below 1.34832 would be a confirmation of this downtrend.
But CIPHER, the positioning data tells a very different story. Pound leveraged funds are net long plus 38,174 contracts, with a massive week-over-week increase of plus 37,416. Isn't that a contradiction to the weak price action?
It's a contradiction that defines a liquidity trap. This is the single biggest anomaly in the book right now. You have nearly 38,000 net long contracts built up in a currency that is failing to break resistance. This is a crowded trade. When price refuses to go up, those longs are trapped. And if price slips below 1.34832, you don't just get normal selling, you get a margin call cascade. The plus 37,416 weekly increase means thousands of new longs entered recently. They are underwater. This makes the 1.34832 level a potential liquidation zone rather than a buy point. The technical weakness grid sees is the precursor to a flow-driven explosion.
SPECTER, does this pound long squeeze pose a systemic risk, especially given the yen positioning?
It poses a massive correlation risk. Look at the yen side. Leveraged funds are net short 60,825 contracts, with a weekly decline of 61,403. This is one of the largest single-week expansions in recent memory. So, you have crowded pound longs and crowded yen shorts. If the dollar-yen pair, currently at 159.447, breaks above its 5-day high of 159.544, those yen shorts will be forced to cover. That covering drives dollar higher, which pulls cable lower, triggering the pound long squeeze I just mentioned. It's a feedback loop. The VIX suppression at 15.28 masks this fragility, but once that loop starts, volatility will expand rapidly. You cannot ignore the minus 60K yen shorts. They are a loaded gun pointed at the dollar-yen exchange rate.
Let's broaden the scope to the broader dollar complex. Dollar-yen is at 159.4475, approaching its 5-day high of 159.544. Grid, what are the technical implications here?
The trend is structurally bullish. We've moved from a 5-day low of 157.657 to approach the 5-day high of 159.544. The current price of 159.447 is testing the upper boundary of this channel. If it clears 159.544 with volume, the next psychological barrier is 160. However, notice the rejection wicks in similar setups. We need to see a clean break. If it fails at 159.544, we might see a pullback toward the 5-day low of 157.657. But the current momentum favors the upside.
CIPHER, is the flow behind this move sustainable, or is it overheated?
The DXY leverage is net plus 4,438, but remember, that's down 7,100 from last week. Some profit-taking has already occurred. However, the yen short squeeze potential I mentioned is the key driver here. The 60,825 short position is unsustainable in a rising dollar environment. The flow is leaning heavily toward dollar strength, but the crowding is excessive. A break above 160 would force a rapid unwinding of those shorts, causing a spike in volatility that the current low VIX cannot handle.
Finally, let's look at safe havens. Gold is trading at 4,396.1, down minus 0.42%. It hit a 5-day high of 4,449.84, but rejected that level. Pulse, why is gold retreating despite the high fear score? Gold is reacting to the higher for longer rate narrative. When the Fed signals restraint, yields stay high, which typically pressures non-yielding assets like gold. However, the 4,396.1 level is still elevated. The retreat is a technical correction within a broader bullish trend. The fear and greed score of 14 supports the bid for safety, but the immediate momentum is being dampened by the strong dollar. The market is unsure whether to buy the dip or wait for clearer signals on the Fed's next move. SPECTER, is the gold rejection at 4,449.84, a sign of weakening safe haven demand?
No, it's a sign of profit-taking before a likely second wave. The rejection at 4,449.84 created a double top risk on the daily chart, as Grid noted. But in a fear environment of 14/100, that resistance will be tested again. The key is the VIX. If the VIX stays below 16, gold acts as a hedge against equity risk. If the VIX spikes, gold becomes a hedge against systemic crash. Right now, it's doing the former. But with the pound and yen imbalances we discussed, the latter scenario is becoming more probable. Watch 4,400 as a pivot. A break below it accelerates the dollar bid. A hold builds a base for the next leg up.
Apex, tie it all together. We have euro-dollar breaking down, cable trapped in a long squeeze, dollar-yen nearing 160, and gold rejecting highs. What is the primary structure defining this session?
The primary structure is defensive rotation driven by policy dissonance. Here's the synthesis.
To summarize today's analysis, this is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.